We are in the middle of earnings season. Markets are about to get another dose of economic data with today's durable goods data and tomorrow's second quarter GDP report. All of this leads up to next week's Fed meeting. So let's talk about the markets and the economy. And joining us for that is Natixis chief economist and CNBC contributor Joe LaVorgna. Also, Michael Santoli, who is CNBC senior markets commentator. Mike, just earnings season again, continuing to get these numbers today. You had 3M, Dow, Southwest, Comcast, all of them here. For the most part, the numbers are pretty good, and companies that are operating even through economic issues like 3M.
That's pretty much the takeaway, is that companies are beating at least at the historical rate. And I think really projecting out from here, the market wanted to see that this flattening out of earnings in the first half of this year was not a cliff, right? And so I think the fact that you can still look toward the later part of this year as having a pickup, it's been good enough given what else is going on with bond yields and liquidity looking supportive as well.
You think there's been a change in CEO sentiment going from what we'd heard maybe a quarter ago, maybe 2 quarters ago, from not being able to see the future to them now saying, OK, we now feel more confident about what's coming?
I think you're closer to whatever you were afraid of 6 months ago, and it hasn't really come to bite. But also, the stock market's at an all-time high. And I don't think anything changes CEO confidence more than that.
Right. Looking at their stock price, feeling,
and feeling like,
more wealthy
okay,
themselves.
things are working fine and we have some room to maneuver.
So what's the real picture, Joe, when you're looking at the economy?
The Fed.
Yeah.
It's the same. We've talked about this many times. It's the Fed. And Michael talks about bond yields, and that's true. Bond yields are falling, but they're falling everywhere. As you know, Greece now has a lower 10-year yield
2%,
than the U.S. 10-year Treasury, which is remarkable. The Fed has the economy's back. The Fed, I think, could make a mistake next week, though, and only go 25. I think they should go 50. I've been very vocal about that. But
why? Why do you think they need 50?
Because they need to try at least wrestle control back from the markets, which basically push them around. And
so you don't even think it's
50,
an economic issue that they need to go 50?
It is.
It's
I do think it's an economic. Well, if they go 50, they'll uninvert the yield curve, number one. And number two, it'll give them some more optionality to not have to go again in September or December because they could be more balanced in their statement.
Why do you think if they go 25 basis points now, it automatically means that they have to go 25 basis
because
points
the market's,
in September?
As silly as this sounds, the market is expecting it. So the market's essentially saying,
tell me what the
market is essentially saying they have to go 75 plus
or
by
what?
year.
Or they have a temper tantrum.
Well, because for two reasons. One is there is a wisdom of crowds aspect of it. And the yield curve has been a very good predictor of cycles.
Market is just right,
but the other thing, Becky, is, and this is important, is that the inversion of the yield curve actually could cause economic conditions to tighten because of the borrowing short, lending long aspect of financial intermediation.
But, Joe, let me get back to the basic point. Do you think the market's right? Is the economy demanding this because of weakness that we've seen from overseas being imported here?
Yes, that's certainly part of it, Becky, and the dollar's been very strong as well.
Yeah.
The GDP data look very good at the moment, but that's always the case. Even if there was an economic turning point, the market, one, tends to be more forward-looking. And if you look at the second half of the year, it's clear from manufacturing, both here and abroad, it's slowing in a world where the Fed believes it's undershooting its inflation target. So given that backdrop, the Fed should be easing rates. It should be lowering rates.
Mike, what do you think the market's demanding? What do you think?
They're implicitly demanding exactly what Joe is saying, because if you think of the math of it right now, if the Fed goes 25 basis points, right, the 3-month yield right now is like 208 or 209, right? So that's where you have this slight inversion, 3 months to 10 years.
Right.
If you only go 25 basis points, it brings the Fed funds rate to what? 2 to 2.25 is the range. It doesn't automatically mean that projecting out 3 months from there, people are going to assume that you're going to go below 2%, right? So you would have to cut 25, clearly say you're probably going to go 25 in September.
And what if the next employment report is soft? Then they're back to, can they do 50 in September?
What if the next employment report is strong after they just cut 50 basis points?
That's fine. The thing is, it's unlikely, even with strong employment, people will meaningfully mark up their GDP forecast relative to where they were in 2018.
I do think, though, Becky, to keep in mind what this one line of thinking from Eric Rosengren at the Boston Fed is saying last week, which is, look, you have markets at an all-time high. The volatility index is at 12. The markets are very flush right now, And so if you do
We're at all-time
ease-
highs, and if the market throws a temper tantrum.
Eric is so far out of the mainstream thinking on the Fed. I think he should be just, I mean, with all due respect to him, he should be ignored.
Okay,
but he
then
represents
why
a faction of people out there.
Why
in the
did John
private
Williams
sector.
have to basically walk it back when he suggested he thinks that they should cut 50 basis points?
Because I think he thinks they should cut 50
but
basis
there was
points.
a call probably that came from the Fed that said, what are you doing? You got to say that this is just you and this is based on academic and not us.
Yeah, absolutely. And it negates the other people on the committee that want to have their voice heard. Sure.
So
but look, it tells you it tells us where the risks are and where they're going, which is lower rates. And inflation, look, the other thing, Becky, is you talked about data. Look at 5-year forward break-even rates in Europe and in the U.S. They're plunging.